Good late morning to our friend on the West Coast. I'm Julien Frazeau, your Director of Risk Management here at Beacon Pointe. So welcome to our May 2023 quarterly macro and market update with our Chief Investment Officer, Michael Dow. So we've got a lot to cover today, but before we bring Michael in, just a couple of housekeeping items as usual. If you have questions, and we already got a lot of questions from you guys, thank you very much, but we will get to the Q&A throughout the course of the call today. We budgeted up to 90 minutes for this webinar as we get a lot of great questions from you, our audience, and we want to make sure that we have time for Michael to address as many as possible. So if you do have a question, type it into the Q&A box at the bottom of the Zoom screen, and we will address those throughout the course of the presentation. Also, note that we are making a recording of this teleconference available approximately 48 hours after the conclusion of this live event. And it will be on the Beacon Pointe website, specifically at beaconpointe.com/videos. So what's on the agenda for today's call? Well, in the first section, Michael will talk about the global economy and capital markets and where they stand. In the next section, we are going to address the debt ceiling debacle and the regional bank crisis. And then we will revisit our cyclical thesis of market implications of late cycle dynamics. And finally, we will wrap up with the outlook for the rest of 2023 and how to position portfolios to take advantage of some of the macro themes that we are seeing take place in the market today. So without further ado, Michael, the floor is yours.
Thank you very much, Julien. Appreciate that. We do have budgeted an hour and a half. I hope to get through most of the material in the first 45 to 60 minutes so that we can leave plenty of time for questions. Please don't hesitate to type in your questions to the Q&A. This is your time, and we want to make sure we're answering your questions. As Julien mentioned, we start with a bit of a discussion of what's happening from a global growth and monetary policy perspective, because it has implications, not just for U.S. capital markets, but for how we feel about global capital markets, particularly international stocks, and most importantly, perhaps the US dollar. So let's jump right in. This is a slide we generally present. It's got your JP Morgan Purchasing Manager diffusion indices on the left. These are global activity measures, and anything that records a reading above 50 is an expansion. Anything below 50 is contraction. And what you can see here is that there was a peak in global activity back in the summer of 2021, also represented here by our heat map that has global developed markets, emerging markets, and then some of the larger economies in the world. You could see there was green is good. That was the peak. We had a lull in the second half of 2022. You can see that both in the global PMIs and on a country-by-country basis here. So what we're seeing now is a resurgence in global activity, particularly in services PMI. Services are recovering very nicely from a bit of a cyclical slowdown. We were in the doldrums here in the second half of 2022, based on probably the significant financial and monetary policy tightening we were seeing globally, not just here in the US, but around the world. And I'll give you an update on monetary policy around the world on upcoming slides. But bottom line is things are looking a little brighter for the global economy today than they were when we last talked 3 months ago. Let's look at global central banking policies and what it means for economic activity. We've had in the last 3 months another 50 rate hikes across global central banks and only 2 rate cuts from Turkey primarily. They had an election over the weekend, so you're going to want to, if you're the president and you want to win the election, you're going to cut rates. You're not going to hike rates. So Turkey's a bit of an outlier, but they've been a bit of a heterodox monetary policy outlier for most of the last 6 or 8 years since Erdogan's been in charge. In the last year, you've seen 246 rate hikes and only 10 rate cuts. And there's been 24 times the number of rate hikes as cuts in the last year. Here's the average policy rate across global central banks. Emerging market central bank policy rates are at 7+%. And what you can see here is the EMs got started a lot earlier in an attempt to defend their currencies, whereas the developed markets took a little bit longer, but the slope is much higher. So there was a bit of a catch up here in developed markets, and now the developed market rate's 3.23. Last 6 months ago, there was a couple of central banks that were negative, but BOJ, the Bank of Japan, is the only central bank now that remains negative. US raised rates 50 bips in the last 3 months, the UK 50, ECB 75, and Japan 0, a goose egg. So Japan's not doing anything to, they don't have an inflation problem per se, and so we wouldn't expect that. And they're pursuing significant financial repression policies to this day in Japan. We'll talk a little bit more about that, financial repression being Beacon Pointe's secular investment thesis. Now, there's a lot of information on this slide, but I think it's important to cover it. So let me dig in just for a second. Global central bank policy rates are going to change over the next 6 months and 1 year period. The 6-month change in the US is forecasted to be about 1 rate cut, where there's at least 4 rate cuts of 25 basis points each priced into the US going forward. If we look across all of our major trading partners, what you see is the US is in rate cut mode, whereas the Eurozone, the UK, Switzerland, Australia, New Zealand, Japan, everyone is in actual rate hike mode. So US and Mexico, which is along with Canada, Mexico and Canada's interest rate policy is typically highly correlated to the US. Most of our trading partners are looking for rate hikes. That has implications for the US dollar, and I'll talk about that in a second. So where is real policy accommodative? Across the Euro area, Japan, the UK, real central bank policy rates are negative, and that means they're accommodative. So they need to go higher. So inflation is also telling you that that central bank policy rates in the Eurozone, Japan, the UK have to go higher because, for example, in the UK, with a 10% inflation rate is 8% above their 2% target. Most of these central banks have 2% targets. So if you want to know what their inflation rate is, just add 2% to this differential. This is the difference between the actual inflation and the target, the central bank target inflation in these particular countries. So what it's telling you is with all of this positive inflation well above the targets, the Taylor rule tells you need to continue to raise interest rates until interest rates are either neutral or tight and are not accommodative. Negative real policy rates are accommodative, and they're inconsistent with an inflation in the current readings that are well, in this case, 4 times this above the central bank's target. Here in the US, we're still 2% plus above our 2% target, but our policy rates are already less than accommodative. They're neutral or even slightly tight versus particularly our trading partners. What does all of this mean? The inflation and policy rate forecasts point towards additional US dollar weakening over the next 12 months or so. And in fact, here is where the dollar stands. We've seen some appreciable weakening already, but the US dollar, this is the trade-weighted dollar, the DXY index, it's trading well above the 30-year average, so it has plenty of room to decline. Here's the DXY forecast between now and the middle of the first quarter of next year. On average, it looks like the DXY, or our trade-weighted US dollar index, is likely to decline almost 6%. Here's the difference versus the Eurozone, the yen, the British pound, the Canadian loonie, the Aussie dollar, and the New Zealand dollar. So you can see across almost all major currencies, there's at least a 3 or 4% decline built in, and across all of them, summarized by the DXY, we're looking for a decline in the US dollar of between 5 and 6%. That has implications for how you want to position your domestic versus international portfolio. We get a lot of questions about where we are in the business cycle. Our cyclical outlook is that we remain in the late cycle. So we're in the late stages of the business cycle. What happens here is one of 3 things. You either get a soft landing, which is very rare. It's what the Fed would prefer. It's what we would all prefer. You most likely get a recession, and we've been talking about a no landing scenario since the beginning of the year. I want to give credit to Torsten Slok at Apollo, who came up with the no landing scenario. All the no landing scenario is a soft landing first, causing the Federal Reserve to hike rates considerably more than they would have otherwise, creating a deeper and longer recession. So the no landing scenario is it's a temporary spot where we were prior to SVB and the regional banking crisis, which we'll talk about in a minute. But here's where we are in the business cycle. Again, one of the most important things that you can determine when you're trying to decide whether to add a little bit of risk or take a little bit of risk out of your portfolio is where you are in the business cycle. And we think we're at an inflection point. Now, we've been sitting here at the late cycle for 5 quarters. We haven't had a recession yet, and a lot of folks are asking, where is the recession that we've heard all about? And the answer is the Federal Reserve didn't start tightening interest rates until March of 2022. And monetary policy, which was specifically geared towards tightening financial conditions and slowing economic activity in the future, there wasn't any tightening until, I don't know, last couple of quarters. Why? Well, the monetary policy works on long and variable lags. So as a result, we haven't seen the recession yet because it hasn't hit the economy as it should and will after 12 or 18 months. Generally speaking, monetary policy works on a 4 to 6 quarter lag. We're in quarter number 5, so we should be seeing the recession sometime in the next 2 to 4 quarters. Where do we stand today? Well, stocks have had a strong start. In fact, they're kind of looking through the recession, they appear to be. They're certainly looking past the regional banking crisis and the debt ceiling nonsense, which I think is fair to be able to do. The debt ceiling we're going to spend 6 or 8 slides on, so I won't preview that now. But stocks have had a strong start. They're up 9% year to date. Outside the US, stocks are up almost 8%. And I'm adding a note, maybe it's getting a little bit ahead of itself. If we do end up in a recession, or if there is further volatility heading into a debt ceiling deal, which we will get, it's inevitable, but the costs of the debt ceiling ruckus are already piling up. I'll talk about those in a sec. But the Federal Reserve has been the primary driver of both our investment positioning and capital market activity, has been for the last 15 years, it remains so, especially during this recent tightening cycle, which caused obviously the negative drawdowns in the equity and bond markets in 2022. But we've had a nice snapback, and we'll see a couple of charts that show you've really got to remain invested through the cycle. If you got out of the market in late 2022, well, you've missed a pretty big rally. So that's something we never suggest that any client do. You need to take on the volatility and recognize that's the price that you're going to pay for building wealth over longer periods. And when the Federal Reserve is on the warpath against inflation, as it has been for the last 5 quarters, you're going to have a headwind to stock prices and bond prices. And again, 2022 is one of the worst years for a 60-40 portfolio we've ever seen. It was the worst year in bonds in 200 years. So the Fed engineered that on purpose. It's an attempt to slow the economy, slow corporate profits, increase interest rates, all of those things combined. But the Fed may be done. They've raised rates 5%, and they may be done. If they are, that'll be very good news, I think, for capital markets. We got a 1.1% positive print on the economy. This is real GDP quarter on quarter annualized. This is the advanced print. It's now the second print. GDP 2020 for all of 2023 is supposed to be 1.1%, but we're expecting another positive print in the second quarter, and then negative GDP for the second half of 2023. So not a great outlook for economic activity, clearly slowing. And interest rates have responded. 10-year yields tend to decline as economic activity slows, and we've seen that. 10-year yields are now trading around 3.5%. And 2-year yields, which have been exceedingly volatile in the period year to date, are much lower post Silicon Valley Bank. I think we've seen the peak at 10-year yields. We called the peak at last November when 10-year yield was trading at 4.24%, and that assumes the Fed's done and inflation is going to be subdued here, and we're likely to have an economic slowdown or a recession. If we have a recession, then 4.24 is going to be a peak for a long time, and you could see 10-year yields decline well below 3% in any kind of a significant recession. There's a lot of recession talk. There's a lot of recession that's priced in, not into the equity market. Clearly, it's not priced into the equity market, but it is priced into the forward curve and interest rates. So you're going to need a deeper or a longer recession to get 10-year yields to go much below 2.5%. But that's possible. It's not that long ago that it's less than a year ago, now a year ago, where 10-year yields were well below 2%. We came into 2021 with 10-year yields at 1.5%. So just level setting, bonds are back. We're up 2.8% year to date on core bonds, and things come back to the Fed. It's always about the Fed. It's always about the inflation outlook, and the inflation outlook remains dependent on the labor market. So we're going to dig into all of those. But let's get into some more information. This is our point of view. This is in most of our client materials, it articulates in a little more detail our current secular theme of financial repression and our cyclical theme of late cycle dynamics. And if anybody wants a copy of this, please shoot me an email and we'll send it to you. Let's dig into capital markets. So this is the S&P 500 going back to January of 2022, when we saw the most recent local peak, record level of 47.97 on the S&P. We're at 41.36 as of the close 2 days ago. And it's been a volatile, wild ride. Since the peak, we had a bear market where we were down 23.5% in the first half of 2022, and then a nice little snapback rally into August, and then recession, when recession fears or an economic slowdown caused market participants to think the Fed was done. And then from August until October, you had fears of additional Fed rate hikes, and the Fed did in fact raise hike rates very aggressively throughout 2022. So you had this tug of war between a recession and Fed pivot argument, which is when the stock market rallies, versus fears of additional Fed rate hikes, which is when the stock market declined. But you can see there's some pretty volatile moves in the last 15 or 16 months or so. And in fact, one of the more volatile moves occurred when the stock market first got the news that SVB was going to fail. That was March 8th, 9th, 10th, 11th, 12th. That weekend of March 11th, 12th was a pretty busy weekend. A week and a half later, Credit Suisse was also taken over by the UBS and the Swiss government and transferred, and apparently resolved much of the regional banking crisis. I'm not so sure we have seen the end of the potential takeovers or failures in the regional banks, but it appears the acute phase of the regional banking crisis is over, and now we're just going to have a grinding reduction in loan and credit available to the economy. And just to be really clear, once banks stop lending, it's inevitable to have an economic slowdown. Credit and lending is the fluid by which the economy operates, and once you slow that down, it's just there is no other outcome. We're at a little rally here from the post SVB lows. And from the October lows, we'll see it's been a really nice rally. But let's take a look at interest rates first. This is Fed funds is the blue line. 10-year yields is the orange line. Sorry, 2-year yields are the orange line. And the purple line is 10-year yields. And I've identified what I think is probably the peaks for each. So the peak on 10-year yields is 4.24 back in October. We're at 3.5% now in 10-year yields. 2-year yields had a really wild ride, especially during the month of March. The volatility in the interest rate markets, particularly Treasury 2-year notes and 5-year notes, is record setting. And you typically do get higher volatility in interest rates when there is a potential inflection point in Federal Reserve policy, and we've certainly seen that. 2-year yields peaked at over 5%, and it's likely we've seen the peak of Fed funds. You might get one more Fed rate hike. If you do, it's because inflation isn't as well behaved as we think. I'll show you some inflation data in a bit. So it's a bit of it's a 50-50 on whether the Fed hikes rates again. They're waiting. They're going to have 2 more inflation prints between now and the next Fed meeting, which is in the third week of June. So we'll see. But what you've seen is the same kind of dynamics in the equity market. When you have fears of Fed rate hikes, interest rates go higher. And when you have fears of a recession causing a Federal Reserve pivot in terms of either going on pause or reducing interest rates. I don't think they're going to reduce interest rates in 2023, but they might. And so that's the dynamic that you see in both the equity market here. Again, a tug of war between recession and Fed rate hike fears, and it's all playing out as you would anticipate. Stock market goes up when the Fed is going to be on hold. Interest rates go down when the Fed's going to be on hold. So, but it hasn't stopped the volatility, which you often see at the end of the business cycle. So late cycle dynamics can be defined as both equity market and interest rate market volatility, and we can see that quite clearly here. Some performance data of equity markets from the low in on October 12th of last year. So this is the year-to-date numbers in 2022 from January 2022, Jan 1 to October 12th. And obviously, horrible market in the first 3 quarters of last year. International stocks down almost 30%, U.S. stocks down 24% at the lows. U.S. bonds down 15%. Of course, money markets retain their stability features, but internationals come roaring back. This in the orange is the outperformance or the performance of the equity market here, in this case, international equities, from October 12th until the end of last month. So down 28, up 32, doesn't get you back to whole quite, but it is a pretty nice rally. Same for U.S. stocks. Again, down 24, up 17. You need to be up closer to 30 after you're down 24 to get to whole, just because of compounding. But you can see there's been a nice recovery. The story here, there's more detail in individual equity markets here if you care to look at them. The key here is probably the significant outperformance of international equities and the performance of large growth stocks at plus 19% since last October versus large value. They've outperformed large value by a considerable amount. Much of that came year to date here in 2023. So stocks go up, stocks go down, stocks go up and down all over again. So invest through the cycle. If you'd gotten out of the market last October, you would have missed a pretty nice rally here. So the point is invest for the long term. And that is also the case if you feel like the Fed is going to be on pause. So this is stock market performance and bond market performance after the last Fed rate hike. So we got a bunch of Fed rate hikes priced in for the second half. So these are the average numbers 12 months after the last Fed rate hike. If the last Fed rate hike was earlier this month, stocks tend to do really well. These are all U.S. stocks here. This is large value tend to outperform large growth. That would make sense. We've already seen a pretty significant growth rally. U.S. and small caps also tend to do very well. International has historically done less well, but internationals had the headwind of the U.S. dollar for much of the last decade. Same with emerging markets. So while I think it's interesting to look at the averages after a Fed rate hike, they don't tell you the entire story. Bonds, not surprisingly, once the Federal Reserve is done raising interest rates, bonds tend to recover very nicely. And so you can see U.S. core and municipal bonds, along with high yield and even short-term bonds. Money markets, they do okay. But these other markets have duration or interest rate risk in them. And we'll talk a little bit about that. Once the Fed's done raising interest rates, interest rates tend to plateau and then come down. And as interest rates come down, money markets perform, well, whatever the yield was when you bought it, that's your total return. But when interest rates come down, U.S. core bonds, high yield municipals, and even short-term bonds, less so, but munis, high yield, and core bonds have interest rate exposure that allows you to take advantage of lower interest rates. When interest rates go down, prices go up, and they go up more for 30-year bonds than they do for 5-year bonds. That's the duration, the magic of duration, which we'll talk about in a minute. The Fed may be done. And if they are, then capital markets typically do better. I included this slide last time, so I'm not going to talk much about it. It's data as of December 31st, and I'm just going to highlight looking at 2022, which is in the blue, and then looking at 3- and 10-year annualized portfolio returns. These are the individual equity and bond markets, but this is looking at a 60-40 or a 70-30 portfolio. Again, the point is, even if you have a bad year, looking back over 3 and 10 years, the returns are in line with historical returns and with our expectations going forward. Invest for the long term. Market tops and market bottoms, you can't time either one of those. They're random events, so you can safely ignore them. Okay, I'm going to stop real quick, Julian. You've got a question?
Yes, Michael, we got a lot of questions, and some I guess I think it's the right time to address them. Specifically, there's a question about whether there's ever been a soft landing, and another one, but we can address it at the same time, which is in the event of a hard landing, where do you see the S&P bottoming? Do you think the October 22 low will stay or will be taken out?
That's anybody's guess on the second one. Julian, as you are, our resident equity expert along with Jason Overholter, I would say this. In a recession, you typically see corporate profits decline pretty meaningfully in as much as 10 to 15, and in some cases 20%. If we're trading at a 17 or 18 times multiple, and that holds, that is, if the multiple doesn't decline dramatically, a 15% decline in corporate profits means the S&P's then 15% overvalued and would correct. Will the October lows hold? Again, anybody's guess, but if we have a severe recession, hey, there's already a recession priced in to the S&P at 41.50. Where are we right now? 41 and change. But you would expect to see corporate profits revised downward. The only question is, how far ahead are investors looking? Are they looking to 2024 corporate earnings? Can they look through any decline in expectations for corporate profits over the remainder of 2023 and look into 2024? If they can, then it's less likely we would have a severe downturn. As it relates to whether you can get a soft landing, I mentioned it's pretty rare. In the last 8 or so Fed rate hike cycles, you've had one soft landing back in 1994. And economic activity did slow. It just wasn't defined as effectively as a recession. So it's possible, but it's highly unlikely to get a soft landing. And now with the regional banking crisis kind of piling on to the headwinds to the economy, the regional bank crisis, which we'll talk about in a second, has likely accelerated the tightening of financial conditions. Again, tightening financial conditions just mean that the cost of doing business in the US economy is increasing. You raise interest rates, you widen credit spreads, you reduce equity prices. All of those things taken together raise the cost of funding of the US economy. And as you raise the cost of funds for the US economy, economic activity, Corporate Finance 101 says, has to decline. So I'm highly confident that we're going to have a slowdown, especially in light of the regional banking mess. Any other questions that are consistent that, Julian, we should address at this point?
Yes, I think we can also address two questions specifically on inflation and the Fed. So I guess the first one is about what metric, what PCE or CPI number, magic number will get the Fed to easing.
Yeah.
And I guess the next question, which is related, is about inflation and unemployment. So can you see inflation really going back to 2% without headline unemployment rate going high, which they haven't really moved yet?
Those sound like Neil questions, so let me address those head on. 3% PCE, we're about 1.5 points away. The Fed is likely, and as inflation continues to come down, monetary policy continues to tighten, even if you don't raise interest rates, because it's all about the policy rate less inflation. It's the real interest rate that matters for either boosting or holding the economy back. So right now, the real policy rate in the United States is barely positive. Just got positive last month. So it's possible the Fed could stay on hold here and just wait as inflation continues to come down, which will increasingly tighten financial conditions. Will they wait to cut rates before PCE is below 3? I think yes. I think they will be darn sure that they don't repeat the mistakes of the early 80s when you needed 2 recessions. The Fed started cutting rates too soon and had to create another recession 18 months after the last one to get inflation back in line. I do think inflation expectations are incredibly well anchored right now. And as long as they remain so, the Fed doesn't need to do much. I think they can go on pause here for a little bit. Was there another question in there? I'm sorry, Julian. I don't know if I addressed it.
No, I think there's a second part of the question was about the unemployment rate.
Oh, yeah, the unemployment rate. Sure. So the unemployment rate, anytime the unemployment rate is 0.5% higher than its 3-month moving average from the lows, and we're at 3.4% on unemployment right now, which is a 54-year low. Anytime if it gets to 4%, we're almost with near metaphysical certainty you're going to be in a recession. That is the empirical data suggests that that's the economic sacrifice required to combat inflation. You need to throw 0.5% times 150 million people out of work. 150 million is the workforce. So an unemployment rate increase of 0.5% always indicates a recession. And our expectation would be that we will likely be there. The labor market's been incredibly hot, but it's starting to show signs of finding a new equilibrium in terms of job seekers versus the jobs that are available. And we've talked a lot about how you can get a soft landing here in the United States if the labor market evolves in a particular way. That is, if the labor force participation rate continues to increase, that'll increase the supply of labor, which will take the pressure off of wages, and the Fed doesn't need to raise interest rates as high. So right now what we're seeing is an increase in unemployment claims, and we're seeing a decline in jobs available. And that is that we're hiring signs put in the front window of businesses. We're seeing less of that. And as a result, the Fed's getting what they want. So we're in kind of Goldilocks territory right now. GDP is positive. The inflation rate's coming down and the unemployment rate is very low, but labor is a lagging indicator. So we won't see the impacts in the labor market for another probably quarter or two, and during that period, we anticipate it'll rise perhaps as much as 0.5% and get us to recession territory. We're going to have a recession. It's just a matter of how deep or how long. Any other related questions, Julian, or should I jump right into?
I think we can move to the next section, and then there are a lot of questions regarding debt ceiling that you're probably going to address.
Yeah,
I'll ask them at the end.
Thank you. It's I hope to cover the information people are looking for, but if I don't, please make sure you ask. Here's the debt ceiling situation. It was established in 1917. It was actually done originally to make it easier to issue debt during World War I. It's been raised 78 times. It needs to go higher between now and June 1st or June 8th. Somewhere in that first week is the X date. The X date is when the Treasury has run out of accounting gimmicks and tricks and will have to default on something, either payments to the military, Social Security, Health and Human Services, education, state and local government support, or bondholders. And there is no facility for prioritizing payments. There is no ability to as some people have suggested, invoking the 14th Amendment and paying bondholders and avoiding a default that way. If you don't pay somebody else, it's still you're defaulting on your obligations. You're just not defaulting on Treasury debt, which would be catastrophic, to be perfectly candid. The thing about the debt ceiling and what's sort of frustrating to should be frustrating to all citizens, but those that understand that the debt ceiling doesn't authorize new spending. By raising the debt ceiling, you're not blowing up the budget. The debt ceiling has nothing to do with the budget. The debt ceiling is just the rule that was established 100 years ago that says you have to have a separate vote to figure out how to fund the expenses that you've already appropriated, in many cases, years or decades past. So because we run a budget deficit in the United States, we don't have enough funds that come in versus our expenses. You need to borrow money. And the debt ceiling is supposed to cap the national debt. Now, let's be really honest about this. The debt does need to be addressed, and we've said this for 3 years now, the debt is going to be addressed during the next 3 to 5 years in a meaningful way through financial repression. It's really hard to reduce the debt levels in the United States through austerity and reducing services or increasing taxes. No politician gets elected for saying, we're going to provide you less services and we're going to raise your taxes. And that's how you balance the budget. And that a balanced budget would cause the debt to stabilize and decline over time and create a primary budget surplus. But that's not likely. So there are some tricks that the politicians in Washington, D.C. can use, typically when you have divided government. And that one of those lately has become using the debt ceiling as a political football. It is being currently used as a partisan cudgel in Washington, D.C., and it happens regardless of, it's usually the majority in the House of Representatives when the party in the White House is the opposite party, regardless of who's in the House and who's in the White House. And it's an attempt to force them to accept the administration, the then current administration, to accept significant spending cuts. And we'll talk a little bit more about that. Here's what you need to know. There is no facility in our financial system to basically account for the day after a U.S. Treasury security is due, and then no payment is made. It typically goes away because it is assumed to be paid. So the burden on the financial system, not to mention the capital markets globally, which rely on the U.S. Treasury as the risk-free rate. I mean, think about where risk-free rate shows up globally in capital markets. It's the basis for trading every other security. There's a risk-free rate, an R sub F in the Black-Scholes model. There's a risk-free rate in a discount, equity market discount, dividend discount model. There's an R sub F in the way corporate bonds trade and sovereign debt trades across the world. If R sub F is unknown, and in fact it's going to be higher if we continue down this path, it throws the entire valuation of capital assets into question. So it's really bad. I don't think there's not enough economists or financial people in Congress to fully understand that, but it would be really, really bad. And if they understood it better, we wouldn't be here, and we'd abolish the debt ceiling, which I think we should. But let's jump in. Where are we now? 31.4 trillion in total national debt. That is the ceiling today. We're at 31.4 trillion, which is 120% of GDP. It's been raised 23 times since 1990. Here are the increases. The biggest one was almost 6.5 trillion due to the COVID stimulus. We spend too much money. We need to address the debt issues in the United States. The debt ceiling is not the thing to do. It's not the right way to approach it. You should do it during the normal budget process. So let's take a look at the numbers. There's the big four, which is the minority and majority leaders in the House and the Senate, plus Biden would really be the big five. Those are the folks that are negotiating. Frankly, their staffs are negotiating. And while Biden's in Japan now, their staffs are digging in. They're trying to figure out areas of common ground and a solution to the debt ceiling. The problem is when the Democrats and the Republicans negotiated on the debt ceiling back in 2011, when the U.S. was downgraded from AAA rated to AA plus by S&P, Joe Biden was the point person for the Obama administration, and he was scarred by that as the vice president working with the Congress. He was viewed as caving, and he's not going to do it this time. So the battle lines are drawn a little bit deeper. 2011 was the big debt ceiling problem. We had one in 2013, one in 2015. People don't remember, but the one here that we're facing is difficult. It doesn't matter, by the way, what the big four and their staffs decide. You still need to get it approved and voted on by a majority of the House of Representatives. 218 is the number. That's the most important number, is 218. If you can't get 218 votes in either the Democrats or the Republican caucus, and it will be very difficult, there's at least a handful of hardcore Republicans who will not raise the debt ceiling under most any circumstances. And if they're forced to do so, they may kick Kevin McCarthy out of his job as Speaker. And if Democrats cave, and if the Biden administration is viewed as caving, it will make his re-election campaign in 2024 all that much harder. Although, quite frankly, 2024 is a long way away. It's really only 18 months, but it seems like it's really a long way from a political perspective. So those are the numbers. Those are the things that matter. And we're watching them very closely, but I'll tell you the bottom line in a sec. There's some common ground. There's areas of some agreements. The Republicans would like to gut the Inflation Reduction Act. They would like to put a 1% cap on future spending and rescind student loan relief. The Dems, it's an easy position for them to have. They want a clean debt ceiling bill. But there are some areas of agreement. Energy permitting reform. Nobody really wants a debt default. And it would be easy to rescind unspent COVID relief payments. And what you're seeing is these job payment work rules to get Social Security and other, not Social Security, but work rules that increase the burden on folks that are receiving government support, particularly for temporary food relief programs, et cetera. The Republicans would very much like to increase the work requirements for that, and the Democrats, particularly the progressive wing, are pushing back against that. So there's still some really, they're far apart on a few things, but there's really no advantage to be gained in any debt default. And the problem here, as I mentioned, the battle lines are drawn a little bit tighter, so it's likely a mistake is possible. It's always possible. And here's the thing that worries me the most. There's no political support for either the Congress, which is at a 60% approval rating, or the president. He's at the lows of his approval ratings to date at 37%, and it's very low, frankly, versus the average for all U.S. presidents in the April of their third year. Biden here at 37% is even lower than Jimmy Carter in April of his third year. The average in the third year is about 53%. So both the Congress and the president are deeply unpopular, and that makes it hard to stake out a negotiating position. Here's the resolution page. Here's how you could do it. How do you get past it? I don't know if it's resolving it to actually do an intentional debt default, but that would get us past the crisis. The cons, of course, of an intentional debt default, there are no pros whatsoever. The cons are economic catastrophe, 8 million people out of work, U.S. Reserve currency status accelerated in decline, our standing as, you know, a beacon of prudence and rationality gets dented further. It's just not a good look. No other country has a debt ceiling rule. Denmark does, but they're the only country I know that has a debt ceiling rule, and they don't use it as a political football. People have talked about minting $1 trillion platinum coin. Yeah, you can do it, but you're going to have some legal challenges. It won't solve the problem. It would be seen by international capital markets as pretty gimmicky. So you could do it, and the Fed would likely be obliged to take it if the Treasury minted it, and then they could spend money. You know, they would deposit. You hand the coin to the Fed, and they just hit a button, and it puts $1 trillion in the Treasury's general account, and they could use it to pay bills and debt holders, et cetera. So it's a possibility. We've also heard about the 14th Amendment, which would allow for prioritization. The 14th Amendment basically says that in no way will the U.S. debt, you know, can't default on the U.S. debt. That's a paraphrasing. Also gimmicky, possible legal challenges and significant logistical challenges. The system is not set up to the Treasury's accounting system. This is just, it sounds ridiculous, but it's a simple thing. You can't just prioritize payments. The system doesn't do that. If they have a payment due, a check goes out. You'd have to manually adjust that system, and that's a logistical nightmare. Here's one that could happen. You could get an actual agreement, and probably a short-term punt, which I'll tell you on the next chart is the most likely. But there's a discharge position that you can be used to avoid a default, because you actually will raise the debt ceiling. It's a procedural end run around the committee system and the committee process in the House of Representatives. Probably you're going to need to find 5 Republicans willing to do it, because the Dems only have 213 members of Congress versus the Republicans 222. So you need 5 Republicans willing to vote for a discharge position. It would probably mean the end of the speakership, and I don't know if it solves the problem. Certainly doesn't solve it permanently, and we're still accruing massive costs to have this conversation. So time's running out. So these are the days that the House is in session, and these are the days that the Senate is in session between now and June 1st. Today is the only day where they're both in session at the same time. Next week, the Senate is out, the House is in. The week after that, the House is out, and the Senate is in for a couple of days. And it takes 72 hours to bring any bill to the Senate floor, even if it does get passed in the House. So, by process of elimination, a debt default is catastrophic, so we can take it off the table with only a vanishingly small probability of any other outcome. A debt ceiling increase will occur. It'll either occur before we hit the debt ceiling and have a technical default, which would be catastrophic, or it will occur after, in which case the reaction of global capital markets will crystallize how bad it really would be to have a debt ceiling crisis and a debt default on U.S. Treasury securities, and immediately bring the parties together to solve what would be unknowable. I can't find. I'm never at a loss for words. I'm trying to find a word that would describe what it would be like, but because it's so horrible, that's why it won't happen. It can't. There's this much of a chance of a mistake. But the way out is being carved by the staff. So we're going to do it, but you're not going to get it done maybe before June 1st. So you're going to have a short-term debt ceiling increase, and this is supposed to say, and broad agreement on top-line cuts, like a 1 or 2%. You know, let's freeze spending in the U.S. Budget and federal budget at 2022 levels, and then we'll increase them by 1 to 2%, maybe something like that. So. You're seeing dislocations in the curve, by the way. This is the U.S. Treasury yield curve. This is what it's supposed to look like for T-bills from earlier this week until the end of next month. So these are the 10 or so T-bills that are outstanding and due over the course of the through the X date range. This is ridiculous. This is what the curve should look like. The normal yield curve should look like this, where you get a little bit more yield if you go from the end of May to the end of June. But because market participants, this is the actual curve. Market participants are bidding up the price of the May 30th Treasury bill, and they're not touching any of the T-bills that are maturing during the June 1st to June 15th period. And then after that, there is some demand. So the market is already market's telling you there's some, they're not saying there's some probability of it happening. They're saying, I don't even want to think about it. I'm just going to buy this T-bill or this T-bill, and I'm not going to buy these T-bills. And that's that. Here, by the way, is the U.S. Credit default swap. So this is the probability. This measures the probability of a default. This goes back to the Great Financial Crisis. You've got these different debt default skirmishes. This is 2011, 2013, 2015. We're at the highest level. The higher the spread, the higher the probability of default. And it's at the highest it's ever been. Now you can take this with a grain of salt because there's not a ton of volume in this contract, but nonetheless, it says some people are concerned about it, but the stock market isn't, and the only part of the bond market that's worried about it, frankly, is this part of the bond market here. So these are the market dislocations we're seeing. I'll stop after just making a comment about what the biggest issue here is. Our reserve currency status is something we should value. It means we have demand for U.S. Treasury securities and U.S. dollars outside the U.S., and that keeps our interest rate and our interest costs here lower in the United States. And demand for the U.S. dollar as a reserve currency, that is, here's the percent of the U.S. dollar that's being used as global foreign exchange reserves. It's averaged about 64%. We're at 58 now. The renminbi, which is always talked about as the challenger, was nowhere on this chart. Now it's only 3%. The only other effective challenger to the U.S. dollar and reserve currency status is the euro. But this is likely to kind of evolve over time. And if we play it right, and if we do the right thing, we can retain our reserve currency status for longer. But this is damaging to our reserve currency status. And it's a privilege. And frankly, there's a lot of benefits to being the world's reserve currency. So we should try and keep it, and we should end this nonsense as quickly as possible. Julian, anything else about reserve currency or the debt ceiling? Any other questions?
No, I think we should continue. We're already 50 minutes past the hour, right, and we have only at section 2 and a lot to talk about, and implications for clients' portfolio. So let's get going.
Let's do 5 minutes on the regional banking crisis, and then maybe we'll skip up to a Fed forecast, and then how to position the portfolios. I'll try to move more efficiently. Financial crises happen all the time. This goes back to January of '80 when Continental Illinois Bank failed, and these are recession periods. But you see, if you put $100,000 into the stock market back in 1980, it's over 11 million. So financial crisis happens, bank failures happen, it's a regular occurrence. And it's important for clients and to understand there is no completely safe haven out there. If you're going to be involved in investing, and by the way, investing is the only way to build wealth. If you're going to be involved in investing, everything has risks. But the good news is the banking regulatory authorities and the Federal Reserve are there to clean up messes. They're not going to be able to limit or completely avoid the damage, but they're there to limit and blunt the trauma. So that's how to think about it. Yes, bad things are going to happen to banks, certain banks. But as a whole, the system remains much stronger than it was in 2008, and even 2008 was just a severe example of a financial crisis. Julian?
Yeah, on that topic, actually, there was a question earlier, which I think is the right time to address now. It was about how safe is my cash at the custodian, Schwab and Fidelity, yeah. And how safe is my cash at smaller state or regional banks?
If you're below the 250K FDIC insurance limit, then you're perfectly safe in a regional bank. And at a custodian bank, if you own something with a ticker symbol, it's not subject to the 250K. I'm not going to make a lot of comments about it because we've already published quite a few pieces out of Beacon Point. I'd ask you to send me an email, and I can send you what we've written. about this topic to clients, but broadly speaking, you should separate uninsured deposits in small regional banks from a custodian that happens to own a bank. But Schwab, for example, is primarily used as a custodian by many of the folks on the call here. And your assets that are at a custodian are segregated from the bank, and they're subject to SIPC, not FDIC limits. There's a lot of information out there about the custodian's limits, and we've written a lot about it. So contact me and I'll point you in the right direction. But you should feel confident that your assets are safe in a custodian for sure. And you should feel confident that many of your assets are going to be safe in any of the banks in the United States. Just be aware of the 250K FDIC deposit limit. I want to go through this really quickly, but it's important to understand what happened in 2022 to the banks. So this is a stylized banking system. If you understand what the bank balance sheet looks like, deposits are liabilities to a bank. With those deposits, other debt, the banks make loans and they buy securities. So bank deposits are subject to run on the banks. Treasuries and mortgage-backed securities are a big chunk of regional banks' assets, and loans are the other. If you start worrying about whether your deposits are safe, you're going to take them out. And I'll show you what that means in a second. It's important, just know this, we have a fractional reserve banking system. All the deposits that you put in the bank, they're not this is how much cash the bank has. These are the demand deposits with, in many cases overnight, immediate demand. You can go into the bank, get your deposits out. This is the amount of cash they have. This is the inherent feature of a fractional reserve banking system, and it's why you have a bank crisis, because all the money isn't just sitting there in a vault. It's in securities and it's in loans. And if you have a bunch of these securities, mortgage-backed securities and treasury securities that you bought a year and a half ago at very low interest rates, and interest rates rose so dramatically, you're going to have losses. Here's the difference in yields over, from, call it March of 2022, when 10-year yields were at 2%, they went to 4%. Fed funds, this is Fed funds here. As the Fed was raising interest rates, all other interest rates rose dramatically. 2-year yields rose the most. They peaked at over 5% from basically 20 basis points back in 2021. 30-year yields also rose dramatically. What happens these are yields here, these are the prices of those same notes on the right. What happens when interest rates rise? Prices fall dramatically. And they fall dramatically depending on where you are on the yield curve. If you're a 2-year note, your price went from par to 96. If you're a 10-year note, your price went from par to 84.5. You were down 15 points. If you owned a 30-year bond, on the other hand, your bond price went from par to 68. You lost 38 points. Think about this. 10-year yield as of March 2022 is 2%. 10-year yield a year later is 4%. That 200 basis point increase times the duration of a 10-year bond means minus 15 points. And there's the calculation. See me if you want more information on that, but it's just math. Higher interest rates equal lower bond prices, and banks owned a bunch of bonds. This is the same. This is the price action on a mortgage-backed security. It also dropped about 17 points. So the assets on the balance sheet are declining, and depositors are taking money out. That erodes the capital of the bank. Here's why the deposits were running, by the way. The actual national average interest rate on checking accounts going all the way back 20 years, obviously banks pay very little on savings and checking accounts. But here's the Fed funds rate as a proxy for money market funds. And what he saw was the differential between what the banks were paying and what you could get in a money market fund was like 450 basis points. So it was easy to move out of a bank, especially if you had uninsured deposits. There was absolutely no incentive for you to leave your money exposed in a regional bank over the 250K FDIC limit when you can move it into a money market fund and be protected at a higher limit and get to 400 points, 4% higher yield. So money market funds exploded. The yield pickup to move from a bank deposit to a money market fund, these are money market fund assets. You can see what happened basically in the month of March. Money fund assets were already increasing. So deposits at banks were declining already, and then it accelerated pretty meaningfully. They exploded. So here's what happened. You had bank deposits declining. Okay, the depositors withdrew swiftly and unexpectedly. That means all of the securities that you had you have to sell securities to raise the cash to pay your depositors, and you're crystallizing these what were unrealized losses into realized losses, and that causes your bank capital to decline. And when the bank capital declines, the regulators show up at your door and try to merge you with a more a safer bank or a better capitalized bank. So this is all should be expected. This is a well understood. There's much of the academic literature on bank runs circles, centers on FDIC insurance and what that level should be. But this is the inherent feature of a fractional reserve banking system. Here are the results, and I'll quickly get through those. Loan volume. So going back to what the balance sheet looks like, if your deposits are shrinking and your assets are shrinking, you're not going to be willing to make more loans. So loan volumes, which were already declining in the second half of last year, and actually we're starting to stabilize and recover at lower levels, but still negative growth rates, are taking another hard turn south. So bank lending has rolled over significantly, and consumers are finding the ability to obtain credit for buying durable goods, large household goods, as interest rates increase. It's the tightest environment for personal credit since the great financial crisis. So current conditions are not very good for lending at this point. Credit card delinquencies are starting to increase. All of these things are messages to economists to suggest that the economy is likely to slow even more dramatically than you thought pre-SVB, pre-regional banking crisis. And here's the outlook for the economy. Some things don't look so horrible. I mean, leading indicators show an increasing likelihood of a recession, but it's not all bad news. The labor market still is in the yellow as opposed to the red. Building permits, so the housing market looks okay for now, but there's a lot of other indicators. These are kind of lagging. These are as of April 30th. So if you look at these in real time, it paints a more challenging picture for the economy. Probability of recession is at least 65%, probably closer to 75. I would put it at 75 at this point. So here's where we are in the business cycle. You're going to get a soft landing, a recession, or no landing. And here's the outlook for the economy. We've gone from 3 to 2 to 1 in terms of the last real GDP prints that we've seen, and it looks pretty negative for the second half of this year. So understanding what kind of landing we get is important when you're thinking about where to invest the money. So with that, I'm going to stop right there, see if there's any other questions, and maybe jump right to a couple of slides on the Fed, and then talk quickly about how we're positioned in Beacon Pointe portfolios and why we're there. Julian?
We have a lot of questions, but I think we'll address them when we talk about how to position the portfolio. So if you want to address quickly market implication of the late cycle dynamics, and then we can answer a lot of questions in the last half an hour.
Almost everything comes down to the Fed. Inflation is coming down from the peak. Inflation is now 4% lower than it was at the peak last June, and but it's still in the danger zone. So the Fed can't take their eye off the ball here, but they can potentially pause and let some of the rate hikes that we've seen to date catch up. We do a lot of work on the individual components of inflation. We're looking at core here versus headline. We're looking at goods prices inflation versus services inflation. But this is the one that matters the most. It's called super core inflation. It's basically CPI services inflation less shelter. So it takes out what is typically a lagging indicator that relates to shelter, like rents and house prices factor in tangentially, but it's primarily an imputed rental figure. So this purple line is the one that Jay Powell quotes all the time, and it is moving definitely in the right direction. So this is why I believe the Fed is likely to pause for the time being. If we get more positive developments on super core inflation, it's moving in the right direction, and it's the preferred metric for the Fed. So like lower headline, but you want to see this number down closer to 3.5, I think, before the Fed can start to think about declaring victory. So inflation is still high, but it's moving in the right direction. The most important thing for the Fed is inflation expectations. We talk about this all the time. This is expected inflation in the long run. It's average inflation for the years 2028 to 2032, and it's back in the green zone. So the Fed's done what they needed to do. A year ago, the Fed was risking a loss of their inflation fighting credibility, but they got on the project and raised interest rates the fastest in 40 years. So just know this, again, this is important. They can only raise interest rates, but by raising interest rates, the Fed's tightening all sorts of financial conditions. It was their stated goal to cause the cost of funding in the US to increase by lowering equity prices and increasing equity market volatility, widening the cost of corporate bonds, so widening the cost of funding to corporations, both on the equity and the bond side, and by frankly appreciating the US dollar, that causes our exports to decline and our imports to increase, which reduces GDP. So everything the Fed does is in this financial conditions framework, and clearly they've been successful in tightening financial conditions over the last year. The Fed's not going to be terribly happy about sort of the recovery in the stock market, because that tends to loosen financial conditions. But I think they're going to be okay with this. We're not back on the S&P to anything close to the highs, so they may be willing to kind of look beyond this. The Fed's tighter than the numbers indicate, and I'll just make a comment. There's a way to look at the federal funds rate in conjunction with declines in the balance sheet. That's how you tighten financial conditions, is you increase interest rates and you reduce or quantitative tighten the Fed's balance sheet by letting the assets run off. So you reduce the size of the Fed's balance sheet and you raise interest rates. Combining those two things together, you get a proxy Fed funds rate. So we're at 5%, but the proxy Fed funds rate, which includes balance sheet reductions, is another, it's worth probably four more interest rate hikes. So we're close to 6%. So the Fed is tight. Interest rates, real policy rates are positive. They're positive by over 1% if you include the reduction in the Fed's balance sheet. So the Fed is doing what they're supposed to be doing. And I'll just highlight a couple more items on the Fed, and then we'll move to the portfolios and answer more questions. The peak on the terminal Fed funds rate appears to be about 560 was the peak. Is at 569 to be precise in the fall. But that came down considerably post SVB. So the Silicon Valley Bank and the regional banking system has caused additional tightening of financial conditions in the United States, thereby relieving the Federal Reserve of the obligation to hike rates higher. That is, because of the regional bank crisis, the Fed may be done. Without the regional banking crisis is probably worth 2 or 3 interest rate hikes by the Fed. But we don't have to go there because conditions are tightening. So the market believes now that we're at the peak. More interesting, perhaps, the market thinks we're going to get 2 rate cuts in the next 7 months or 8 months. Between now and the end of the year, the market's pricing in a Fed funds rate that goes from about 5% to something closer to 4.5%. And then by the end of next year, the market's pricing in a total of 8 interest rate cuts. This seems aggressive to me. I think that they're likely to pause. Here's the policy rate neutrality. So this is basically taking the Fed funds rate and backing out inflation. So given that the current mid price of Fed funds is 5.25, and separating out PCE core, which is their preferred inflation index, we're positive. So it looks like financial conditions have tightened enough, and the economy is likely to slow enough so that the Fed can go on pause. A lot of job market information here, but I've kind of summarized it. So let me just say something about what happens in the capital markets after the Fed's done hiking rates. So generally, you see over the next 12 months, if May 3rd was the final Fed rate hike, over the course of the next year, stocks are supposed to rally, both domestically and internationally. We've seen this chart, and bonds are supposed to rally. But here's the thing. There's a lot of interest rate reduction priced into the market right now. That is, some of this data may be somewhat less useful if we don't get the Fed rate cuts that the market is currently forecasting in the second half of this year and for all of 2024. You need rate cuts likely to ease financial conditions and allow the equity market to go up in a recession, and that would happen in a recession, but also in a recession, you're going to see corporate profits declining. So we're sticking with the financial repression thesis, which is the idea that because we're at 129% debt to GDP, the highest level since World War II, you need to get the debt levels down, and you do that by letting inflation run a little bit hot and by suppressing nominal interest rates. In terms of our cyclical outlook, we still think, obviously, we're in the late cycle, and I'll just summarize some of the late cycle dynamics we're seeing. It's primarily volatility related to monetary policy versus a recession. And are we going to see the same kind of repeat of 2022 and 2023? No. We've seen a large increase in capital market volatility, but it's been primarily in the bond market. So CPI is moving in the right direction. GDP is declining and it's likely to go negative. And you have a high degree, and you have a very hot labor market. The labor market remains overheated right now, but it's a lagging indicator. So I expect that the unemployment rate will rise over the course of the next couple of months. But you've got in the late cycle, the most important thing, more vol, higher uncertainty, less compensation for risk taking. I'm not sure we're out of the woods yet, but we seem to be nearing the ends of the Fed rate hike cycle. In terms of what kind of landing, soft landing, not very likely. Recession, much more likely. And a no landing. No landing is just a soft landing, then a hard landing. So the likelihood of a recession is closer to 60 to 70%, in my opinion, over time. But in the meantime, we still have a pretty strong economy. The consumer is in pretty good shape, but seems to be deteriorating. The labor market is in really strong shape, but it seems to be deteriorating. So looking to the future, things look a little challenging from an economic standpoint and from an employment standpoint, but it also means the Fed's going to stop raising interest rates, which would be a positive for markets. So let me jump into a couple. If there's no more questions, Julian, that are related to some of the topics I've just addressed, let me know, and I'll jump right into how to position the portfolio, and then we can leave another 5 or 10 minutes for questions.
Just maybe one question really that's regarding the housing market and the Fed interest rate trajectory. If you could address, what the impact of interest rates have on the housing market. So
the housing market has actually recovered from the surge in interest rates that caused mortgage rates and mortgage activity. Mortgage rates went from 3% to 7% in 2022, and they've come down to close to 6.5%. So the mortgage market seems to have adjusted. It's not going to go gangbusters because there's a lot of folks that are in what we call, interest rate prison. That is, they own a house with a 2.5% mortgage, and if they sell and buy a new house, they got to pay 6.5%, thereby at least doubling their monthly mortgage payments. So the housing market, so there's not a lot of supply that's come on to the housing market. So house prices have held up very nicely. Surprisingly so. The Fed was targeting both the stock market and the housing market over a year ago when they started raising interest rates. But it's hard to see where the housing market goes here. We need more supply. Residential housing is notoriously undersupplied and has been for the last 10 years. Housing and home building used to be 4% of the economy. It's less than 2% now since the great financial crisis. So we need more houses. We need more multifamily. We need more single family residences. So you're going to get more supply, and it'll be the supply-demand dynamic that sorts the housing market. And the demand is a function of household formation and the cost of getting a mortgage. So I'm sanguine about the housing market. Although if we have a recession, it's likely house prices will stabilize or decline slightly. But it also means the mortgage rates will come down as the Fed starts to lower interest rates to combat a recession. So again, the thing about the business cycle and housing and the labor market, we have a very dynamic, resilient economy. It'll find a new equilibrium. So some of the things that we're talking about today are just sort of short-term cyclical issues, but it's important to keep your eye on the long run. That is, the U.S. economy is the most productive. We have the highest human capital here. We have the best rule of law. We have high ease of doing business. It's a very flexible system, and it will adjust. It always does, and it always will, unless there's a significant change in policies, or some other outside exogenous shock that we can't even think about right now, like we lose reserve currency status in the next it'll happen in 3 decades, but it's not going to happen in our investment lifetime. So we can safely set it aside for now. But all of these things contribute to our understanding of how to position the portfolio, which I'll talk about now. I'll answer 1 or 2 other questions that I'm seeing on the Q&A in terms of how much of your portfolio should be in cash assets, for example, is a question we get a lot. And I'll tell you, when you're positioning a portfolio, you shouldn't consider cash to be part of your retirement assets. We don't. It should be separate. Cash should be used for short-term purchases and other obligations that you have over the course of the next 1 to 3 years. But it should be completely separate, and expenses should be completely separated from your retirement assets. Your retirement assets do not benefit from having cash. The things that we did in the last couple of weeks for the portfolios, we were already having, we're about neutral growth stocks. Would have liked to have been overweight growth, but we're neutral growth. We're overweight value stocks, and we're overweight international equities. International equities benefit from a couple of our current forecasts and themes, and the most important one is shown here on the right chart, which is international, the discount of the PE ratio, a valuation metric, PE ratios of the U.S. versus non-U.S. stocks, and it is a historically low level. The chart on the right basically tells you that the international discount is showing international equities are incredibly cheap right now. They're cheap. Why? Because they've underperformed in 8 out of the last 11 years. In the 2010s, or the last 11 years, going back to 2012, so 2012 to 2023, or 2022 inclusive, 8 out of 11 years, international equities underperformed. But in 9 out of the 12 years before that, so from 2001 until 2011, 9 out of 12 years, international equities outperformed. These things go in cycles, and they tend to kind of follow the US dollar. And given what we said about the US dollar depreciating, that is another excellent reason to look at international equities. So 2 reasons to own international: they're cheap, and the US dollar is likely to depreciate, which will provide a headwind to returns on international stocks and bonds. On the left chart, what we're looking at here is, should you own cash or should you own bonds that have some duration? And we talked about what duration is. Duration is your exposure to interest rate risk. The higher the duration of a bond, which is typically linked to its maturity, so a 30-year bond is a longer duration than a 2-year bond, you should have interest rate. You should have pure interest rate duration in your portfolio if you're heading into either a challenging or a volatile environment or a recession. And the debt ceiling and the regional banks clearly qualify as challenging environments, and a recession is our base case. So you would want to add interest rate duration to the portfolios, which we did. We added another half a year of duration to the portfolios versus the benchmark with the changes that we made at our most recent asset allocation meeting. So summarizing where we are, it's still the late cycle. The uncertainty levels are incredibly high. So you should remain overall very close to your risk profile, which is captured by your benchmark, and be neutral. So we're neutral overall risk. We're not taking extra interest rate risk, and we're not taking extra bond market risk per se. When I say we're not taking interest rate risk, we're at the index plus a little bit because we think we're headed into a recession. So from equity markets, we're risk neutral, and we're overweight large cap value, and we're overweight non-US international equities. In terms of interest rate, we have increased slightly the interest rate risk, but again, the overall exposure to growth assets versus stability assets remains neutral. So we've added back just a little bit of duration at higher yields, but we've taken it out of another stability asset. And the bottom line is you should always have a pretty significant allocation to a diversified basket of alternatives. Alternative investments allow you to achieve higher returns, and they're typically uncorrelated with the public markets, so they lower the overall risk of the portfolio. So talk to your advisor or your consultants about what your exposure to alternatives should be. But in our risk managed tactical portfolios, we have typically 20% of an allocation to alternative investments. So stay close to the strategic allocation as volatility increases. But at some point, we're going to be past the uncertainty around the Federal Reserve. We're going to get through the recession, and there'll be opportunities to take on additional risk at that point. I'm going to stop right there, Julian. If you can give me a quick summary of any of the questions that you think would be useful for a large part of the audience, I'd be happy to take them.
Sure. There's a few questions regarding some of the alternative assets. So one was about gold specifically.
Yeah.
It's at all-time high. What's the Beacon Pointe view on the gold as an asset class or in a portfolio?
We don't have a specific allocation to gold in the portfolio today. We had a very small allocation 2.5 years ago into the teeth of what was then a huge Bitcoin rally. And I think gold didn't perform as well as we anticipated, because I think a lot of the demand for non-US dollar or for a dollar hedge went from where it traditionally would go into gold. It went into Bitcoin, and that didn't work out great in 2022. But gold is highly volatile, and it doesn't have a cash flow associated with it. It costs you money to store physical gold. there's financial products that allow you to get exposure to gold price, but that doesn't necessarily capture all the gold benefits of gold. Gold trades on a distress or an Armageddon bid, and it also reacts to interest rates, particularly real interest rates. So as real interest rates rose in the U.S., gold suffered, but as real interest rates will come back down if the Fed starts lowering interest rates and as inflation comes back down but remains above target, real interest rates are likely to remain low, which does increase the attractiveness of an asset that doesn't have any cash flow like gold. But gold isn't owned by institutions because it doesn't have the types of risk reward characteristics that make it additive to an overall portfolio. And I never think about individual line items. We always think about the overall portfolio when we're thinking about how to get clients to where they want to go, whether you're an institutional client or a private client. It's the overall portfolio that matters. Adding gold to the portfolio increases the volatility more than it increases the expected return. And it does so in ways that have not historically made us want to include it as either a strategic or rarely as a cyclical asset. So at all-time highs, it's probably not, it'll do really well if the US dollar loses its reserve currency status. Gold in US dollar terms will explode. So, maybe over the longer term, given our debt issues, I mean, we're going to reduce the debt. It's not going to be easy. It's going to take some budget balancing. It's going to take higher inflation, which debases the currency, which is good for gold. So there's a couple of things about financial repression that make gold perhaps a little more attractive, but it's really, really hard to catch gold when you're supposed to buy it low and sell it high. So we typically don't include it as a cyclical allocation, and we don't have it in the portfolio today.
Michael, you just talked about the attractiveness of international equities, and there's a question about, which countries in particular you recommend, and I guess maybe you want to explain how we look at it by more like emerging markets and developed markets regions.
Yeah. So I was the global head of sovereign research at UBS prior to taking on this role, and I'll tell you, the amount of analytics and analysis that's required to make individual country bets. I mean, I had a team of 5 people. It's difficult to do, and in many cases, not highly productive. So here at Beacon Point, we look at regions. We look at the U.S. and Canada and Mexico, so call it the Americas. We look at IFA, which includes Europe, the Far East, and Australasia, including Australia. And we look at APAC, or the Asia Pacific region, also developed and non-developed, and we look at emerging markets. So we look at broad regions when we're thinking about where to place our allocations. And that's the kind of managers we hire. So we hire managers that then make the country and currency decisions for us. And our managers have done very well in the international area in 2023. But that's cyclical too. They underperformed slightly in 2022. Sometimes they had too much value and not enough growth, and sometimes the other way. But over longer periods of time, and again, picking countries, picking regions, all of this, you have to look at it in the context of a portfolio, overall portfolio context, and over a 3-year horizon. So we look at international broadly, make a decision about the broad valuation metrics of IFA and emerging markets. They look attractive to us on a valuation basis, and they look attractive to us based on our outlook for the US dollar, and hence we're allocating more assets to the managers that we hire to make the country level decisions, country and company level decisions.
Another question on the scenarios, and like a doomsday scenario like we had in 2022, where you would see both bonds and stocks sell off.
Yeah,
what would it take?
That's a good question.
Happen again
for inflation to accelerate dramatically. The reason we had 2022 is because we came into 22 with 10-year yields that had a 1 handle. That is, January 1st, 2022, 10-year yields were 1.51%, so 1.5%. They're 3.5% now. So you have a significant yield cushion should interest rates go higher. You're not going to suffer the same loss of principal in bonds that you did in 2022 because we're at a much higher starting point. It's the beauty of bonds. Bonds have a self-correcting, almost a mean reversion type feature to them. Not bonds that have default risk, but treasury securities. And we aren't going to default on the treasury securities, by the way, just to make a really fine point. Risk-free treasury securities, when the bond prices go down and the current yield goes up, your running yield going forward it goes much higher and provides the hedge necessary. So there's a big difference between the environment we're in now and the environment we saw in 2022. We're not at record highs on the stock market, so valuations aren't as stretched as they were in January 2022 for either stocks or bonds. So it isn't about, things don't happen in a vacuum. I mean, if stocks are overpriced and something bad happens, they're going to drop dramatically. If stocks aren't overpriced and something bad happens, then they'll drop less. But it doesn't matter. You want to invest for the trends, and the trends in the U.S. economy, the trends in the global economy are invariably positive over longer periods of time. So if you can take a step back from the wiggles and just concentrate on the trends that you are getting in a portfolio that's managed here at Beacon Pointe, that is a portfolio that's risk managed to your risk profile. That is, we're saying you have a risk profile that you've identified and it's in your financial plan. And in that financial plan, there's assumptions. We're building a portfolio that reflects, respects, and takes as our first priority the assumptions in your financial plan or in your IPS statement for institutional clients. And we're going to manage the portfolio, risk manage it to those specific investor requirements, whatever they are. So and we're going to do it over a 3-year period. We're not doing it over quarters or 1-year periods. It's impossible to manage money that way. So focus on the trends, not on the wiggles.
Michael, there was a question quoting Ray Dalio and his theory of investing in uncorrelated assets. Yeah. So the question is, how do you construct a portfolio with say 15 uncorrelated bets to have the safest and most diversified portfolio? Is that even possible?
Well, not the way Ray Dalio does it, except at Bridgewater, and for most clients it's not accessible and maybe not even desirable. That is, the way I think about the world is it's pretty straightforward. You have a global opportunity set that you have available to you, and it includes international stocks and bonds, U.S. stocks and bonds, alternative investments that are just international and domestic stock and bond type investments that are packaged in limited partnership or other less liquid vehicles. So you have this opportunity set, and with Stephen Marshall's help, Stephen is our head of asset allocation here at Beacon Pointe. It's not that difficult using simple optimization techniques to figure out how you should put those strategies together. So his point is well taken. A diversified portfolio of 10 to 15 asset classes is exactly what we do. That's exactly what we're trying to do. We want to be on the efficient frontier of investing, which means there's not another portfolio we could construct for you that has a higher return and the same amount of risk, or that has lower return, that has the same amount of risk and a lower return. That's optimized. That's an efficient portfolio. An efficient portfolio is on the efficient frontier, and there's no better portfolio from a risk return. There's no more optimal portfolio from a risk return standpoint. And that's all about understanding the standard deviations and the correlations between assets. And it's perfectly consistent with what Ray Dalio is saying. He may have access to other types of uncorrelated strategies that are unique to where he sits, very niche-y things. But we have an incredible alternatives research team headed by Derek Newcomer here at Beacon Pointe that is tasked with finding those niche-y type alternative investments that are so very additive to client portfolios because they're uncorrelated. And they capture risk premiums that aren't available in public markets. So talk to your advisor and your consultant more about those. But that's a significant component of how we build portfolios using what we call the endowment model. The endowment model gets clients where they need to go with the least amount of risk. What else, Julian? Anything?
Yeah, one question, I guess, on BP core equity. A client is asking whether it's been recommended to add exposure. So it's really hard to answer specifically, but maybe you can explain how we use equity.
Yeah, so Julian runs BP Core Equity. It's an individual equity strategy that is tightly risk managed to the S&P 500. So if you're interested in individual equities, we do that. Most of our assets are managed by active or in many cases passive managers that we hire. The benefits to BP Core Equity is it gives you line item exposure to individual equities, and we offer it to Beacon Pointe clients for free. So that's something Julian and a couple of members of our Denver office and Dallas offices manage, and it's quite effective. It's gotten a lot of traction in the last 18 months. See, you're interested in that type of a strategy, please see your advisor or consultant about it, but it's something we're pretty excited about.
Quickly, maybe one question we can address about selling call options for on stocks. Is that considered part of a recommended portfolio?
So selling call options is a pretty common strategy, but it's a volatility-based strategy. You're supposed to sell call options, when volatility is high, and buy them when they're low. That is, you're making a bet on volatility going forward. It's no more complicated. It is complicated, actually. It's a lot more complicated than most clients perhaps fully embrace. It isn't free. I mean, you can't just sell call options and take the additional option writing premium directly to the bottom line. You have to be able to do it effectively and do it right, and not own call options or put options or any kind of an options overlay strategy when volatility is low and then explodes, because your position will, if you're, depending on whether you're long vol or short vol, your position will either enhance your total return or completely destroy it. So call option strategies are best left to the pros. We have a couple of managers that do that, and we have quite a few clients that are involved in call option writing, and for the most part, they've been pretty satisfied. It's not for everybody. Again, see your advisor, but it's a way to add. Generally speaking, realized vol is lower than implied vol, so you can generally make some money in a strategy like that. But it works, it works most of the time, and then it doesn't work. And when it doesn't work, it has a tendency to wipe out a couple of quarters worth of return. So take these things, be very careful with any kind of strategy that has conditional payouts like call options. There's another question here, Julian, about tips. I wonder if I could just make a quick comment about that. Tips, you're supposed to own Treasury inflation protected securities when inflation expectations are very low and you expect them to rise. Inflation expectations are already rising, and tips tend to underperform when inflation expectations, even if they're high, are declining. So same with CPI. Actually, you get paid to own tips when the CPI is unexpectedly, the consumer price index, which is embedded into the price of the tips, is unexpectedly high and rising. That's the time to own tips. So we owned tips for about 1.5 years, starting in September of 2020. They were a significant part of the portfolio, and they outperformed nominal bonds considerably. And that's how I think about them. They're not a strategic allocation in the portfolios, but you buy them as a cyclical allocation when your outlook for inflation is different than what's being priced into the market. And back in September of 2020, just in the heels of all the fiscal stimulus and monetary stimulus that was happening, we thought inflation was going to be a lot higher, and turns out it was. So that was the time to own tips. We don't own them in the portfolio right now. Some of our managers may own them in small amounts, but we don't have an overlay of tips in the portfolio today, but we have in the past. We're at 2:30 Central Time, 12:30 Pacific. Julian, any final wrap-up comments?
Well, I think we addressed most of the questions, but we have a log of them, and so we'll go through the log of questions and make sure that if we haven't had the chance to do it during the last 90 minutes, we will get back to you by email or ask your advisor directly to get back to you. So thank you, Michael, and everyone. Please look out for our invite in your email inboxes for our next quarterly macro and market update around the middle of August. So until then, be safe and see you all next time. À bientôt.
So long, everybody. Thanks for joining.